As a first-time homebuyer, the home buying process can be extremely confusing. So it's important to educate yourself as much as possible up front so you're prepared for what's likely be the largest purchase you have ever made. Watching this video is a step in the right direction, since I'm going to share my top tips for first-time buyers before they start their home search. So let's start with your employment. Pretty simple here. For one, unless you have a fixed source of income, such as Social Security, disability, trust, pension, whatever it might be, you need to be employed. You need to have some sort of source of income from a job. Now, ideally, that's a W-2 job, unless you're self-employed and have a 2-year plus history of self-employment. So it's easier to qualify as a W-2 employee or a newly employed individual than it is to qualify as a self-employed individual, which would be someone that's even a 1099 from a company, like a travel nurse or maybe a consulting job where you're not actually employed by the company. You work for the company, but they don't employ you. They give you a 1099 and you're responsible to pay your own taxes, file it, and do that on your own. Ideally, if you're going to buy a home, you want to be a W-2 employee if you don't have a 2-year history of being self-employed. Now, what happens if you just graduated from school, whether it be high school or college? Well, as long as you have a degree, whether it's high school or it's college, and now you have a job, if it's college in a related field to what you graduated from, we can actually count your schooling as work history. So you might have heard that you need to have a 2-year work history before you can actually qualify to buy a home. If you were in school for the 2 years prior to starting your job, and now you've maybe been on your job a month or 6 months, or maybe you haven't even started your job yet. Maybe you have an offer letter with a start date that's going to take place after you want to close on a home. Believe it or not, we can use that. Like I said, W-2, not self-employed. But you can actually count the schooling as work history. We can use an offer letter as long as the start date for that job is going to be within 60 days of the closing date on the property that you're buying. It's either a salaried position or a full-time position. The offer letter needs to reference what your rate of pay would be, whether it's a salary or hourly, the number of hours that you're working, full-time, let's call it 40 hours per week. If there's any contingencies to your employment, all of those have to be cleared before we can close on a home. But assuming you can provide those things, we can actually use schooling combined with an offer letter for employment to qualify you for a mortgage. Now, let's just say you had a different job and now you have an offer letter for a new job. Maybe it's a higher paying job, or maybe you're relocating from one state to another, or within the same state but a further distance than what you would drive for work. And we have that offer letter, we can do the same thing. We can use the offer letter toward qualifying you for that mortgage, and you actually don't even need to start the job prior to closing. You would just need to provide that letter showing a start date within 60 days. All contingencies need to be met, and we can do that. Let's just say you were self-employed and now you're going into a W-2 position for a company that you don't have any ownership in. Same thing. We can use that offer letter. Let's just say you transitioned from being self-employed and you've been working for the last 6 months as a W-2 employee of a company that you don't have any ownership in. We can consider that as well. So all these things pertain to employment and how that can be utilized toward qualifying. So your employment as a first-time home buyer is extremely important if you do not have a different source or a fixed source of income outside of what would be employment. So like I said before, Social Security, pension, anything along those lines, disability. So keep those things in mind. Employment is very, very important. You also want to know what your true credit scores are. And when I say true credit scores, I'm saying that because we speak to a lot of people that want to get qualified for a mortgage that are basing their credit scores off of what they see on Credit Karma or maybe their credit card website. Oftentimes, those scores are not going to match what a lender pulls when they're actually qualifying you for a mortgage. And that's because there are so many different FICO models. Lenders look at your FICO score, but there's like 9 different FICO scores that you can have depending on the type of credit you're trying to apply for. And oftentimes, the credit score for a mortgage is lower than that of a credit card or an auto loan. So if you want the most accurate credit scores, and maybe you're not quite ready to have a lender pull your credit, right? Even if it's a soft credit check, which doesn't affect your scores, maybe you're just not at that point where you even want to talk to a lender, right? So we want to go path of least resistance here for you. I would recommend looking at the MyFICO app. You can also go to myfico.com, MyFICO. That is a paid app. Just so I want to be clear here, I do not make anything by telling you this, but the scores on that app are the most accurate scores I've ever seen, and you can actually specify the type of credit you'd be applying for, and it will give you the correct scores for that type of credit. So on that app, it's going to show you all three scores because there's three credit bureaus, Experian, TransUnion, and Equifax. Lenders pull all three. We take the middle of the three. So you want to know all three. But you can choose mortgage once you're in the app, and it will give you your three mortgage credit scores, and those are accurate scores. So you want to keep those things in mind. Now, you also want to budget, right? What are you comfortable paying? Because you want to keep in mind, first of all, that when it comes time to apply for a mortgage, what you're comfortable paying may not match up to what you're qualified to pay. What you're qualified to pay may be greater than what you're comfortable paying. And the reason that may be the case is because you know how much money you actually take home every single month. Lenders, on the other hand, mortgage lenders, are going to qualify you off your income before taxes are deducted. So not what you're actually taking home. We know you pay taxes, right? Just like everyone. We qualify you off that higher number. So it may not be realistic. If we're allowing you to use 45% of your income before taxes, well, let's just say you pay 20% in tax. That means we're closer to 70% of your income in qualifying. That's probably not proper budgeting for you, right? So you can sit, all of your expenses, what you really take home every single month from your job or whatever type of income you have coming in, and you'll be able to budget properly and determine where you want to be as far as your monthly payment is concerned. And when I say your monthly payment, to be clear, I mean the mortgage, property taxes, and homeowners insurance. Now, you're also going to have utilities. You want to keep that in mind. Those aren't things a lender looks at, but those are things you're going to have. So you probably want to include those when you're working on your budget. You also want to be able to calculate your debt to income ratio because, like I said, your budget and what you qualify for may not align. So I said they may not align because maybe you qualify for more than what you're comfortable paying, but it also goes the other direction. You may want a higher priced property or a higher payment than what you actually qualify for because you may say to yourself, well, I pay $2,500 a month in rent. I should be able to qualify for a $2,500 a month mortgage. Well, that may not be the case. So what you want to do is you want to sit down and you want to calculate out your DTI, your debt to income ratio. And that ratio is going to take your gross monthly income. So I'm going to use high numbers. I know this doesn't apply to everyone naturally, but it's just simple math. Let's just say your income was $10,000 a month. And we as a lender say that you have to be at a 45% debt to income ratio or less. That means you would take that 10,000 times 45% and you would get the answer 4,500. 4,500 would be the max that all your debts, including the new home, can add up to and qualify for that mortgage. So you want to calculate your debt to income ratio and utilize that. See if your debt to income ratio aligns with what you budgeted for. If they align, that's fantastic. That means you're looking at a realistic price point and payment for what you actually make. Now, you also want to put money aside to use toward your purchase, right? We've talked about your income. We've talked about how that applies to qualifying and budgeting, but you also want to put money aside to use toward your purchase. If you're not a military veteran or active duty military being eligible for a VA mortgage where it doesn't require a down payment, well, for one, you're gonna need money for a down payment, and two, you need money for closing costs. And if you should definitely watch my other videos and subscribe where I talk about different types of loans, how much money you need for a down payment for each loan type, and how much money you need for closing costs when you're purchasing a property. I break that down in detail, and I highly recommend you watch that video because it's a lot of good information, and it's definitely gonna help prepare you for when you're ready to actually move forward with the home buying process. But you do want to save something, and if you can't save something, maybe you're lucky enough to have a family member that's able to gift you money toward your purchase, right? Gift funds are money that are not expected to be repaid by that person who's giving them to you. So, there are a lot of lucky people out there. We see them pretty often. Parents, grandparents, aunt and uncle are in a position where they can actually give money toward this person's home purchase without expecting to be repaid for it. And that money can actually be used toward a down payment. But if you're not that lucky, you need your own money. And something that a lot of people surprisingly don't realize they can do is if they have a retirement account, they can actually pull money from that retirement account to use toward the down payment on their home. And oftentimes you can do this without penalty. It's called a hardship withdrawal because it's being used to buy a primary residence, but that's something you would need to speak to your retirement account provider, whether it's a 401k or an IRA. You want to reach out to them and find out if they allow for hardship withdrawals for the purchase of a property. An alternative to that, if you do have a retirement account, is you can take a loan against your own retirement funds. And because you're paying yourself back that money, we don't have to count that toward your debt to income ratio. So although you're paying yourself back, it's not an added expense in the eyes of the lender because you're the one receiving that money back from yourself. Now, let's just say you can't save any money. It's just not possible. You don't have access to gift funds. You don't have retirement or savings. Well, there are down payment assistance programs out there that you're going to want to look at. And check out my other video that's specifically about down payment assistance programs, where to find them, the different types of programs available. But those are programs that will either give you money that you have to repay or money you don't have to repay, depending on what you qualify for. But it will cover the down payment and in some cases even the closing costs on the purchase of your property. Now, once you've done all that, you're pretty much prepared to talk to lenders. And you want to look at your options, right? You don't want to necessarily go with the first lender that you speak with, unless, of course, that lender is me, right? No, but I'm kidding. You do want to look at options, right? It's always a good idea. And so you want to be able to talk to people. For one, you want to find someone that you can jive with, someone you're comfortable with, right? Everyone's different. Some people will naturally go to their bank because they think, oh, my bank, that's where I have my money. I want to go to my bank. But then maybe the banking hours don't work well for your schedule, right? If the person that you're speaking with at the bank is only available between 9 a.m. and 5 p.m. Monday through Friday, but you're not available because you're at work during those times and you're only available to speak after 5, or you're only available on a Saturday or a Sunday, well, maybe working with the bank wouldn't be the best option in that case, right? You want to work with someone who is available. I know that my team's available 13 hours a day, 7 days a week, right? It's 91 hours a week. And I have a team of 7 people who are available to speak with our clients regularly, answer questions, run numbers on properties, help get pre-approvals out, and call listing agents when offers are submitted, right? These are things that matter when you're shopping for a lender or looking for the right lender. It's not just the interest rate. Of course, that's something you're going to want to look at, but not in the beginning. In reality, the interest rate's irrelevant in the beginning. The rate matters once you're under contract for a property. You're not locking an interest rate at the first conversation you have with a mortgage lender when you're going to eventually get pre-approved, which is the next step, right? The next step after finding the right lender is getting pre-approved for a mortgage. Not get pre-qualified, but pre-approved. The difference, pre-qualified, means that you speak to a lender, have a brief conversation, give some basics about yourself, your income, so on and so forth, have credit pulled, but don't provide any documents to support a single thing you've told them, right? Not that you're lying to the lender, but it's like putting a cast on an arm because a patient walks into a doctor's office and says, my arm's broken. What doctor does that? They're not going to do an x-ray? The pre-approval is like an x-ray. Pre-qualification is just throwing a cast on that arm without determining it's actually broken, right? So pre-approval, you're going to provide all the documents to support the conversation that you have with that lender to make sure everything matches up. And it's not, like I said, it's not that you're lying to that lender. It's that you don't do this all the time. Maybe you're self-employed, right? And your business makes $100,000 a year. And you tell this lender, hey, I make $100,000 a year. Well, you send your tax returns over to the lender once you go under contract for a property because you did a pre-qual, not a pre-approval. You waited and kind of did it backwards. And now they noticed on your tax return that, yes, your business did bring in $100,000, but you only made $30,000 of that $100,000 because it cost $70,000 to run your business. That's where it's very important that you get pre-approved up front. In the pre doesn't mean before you submit an offer on a property. It means before you go out and look for property. You want to make sure you're in the strongest position possible. And the only way to do that is to get pre-approved for a mortgage before you start your home buying process. And once you've done that, you want to find yourself a buyer's agent. That's a realtor who will work with you, find the right property, look out for your best needs. You hear a lot of talk about these recent changes with buyer's agents and them being able to get commissions on properties. In my opinion, that entire NAR, National Association of Realtors, was completely backwards, the settlement. First off, a buyer's agent plays a pivotal role to you as a home buyer. They're the ones who are going to find the right property for you. They're the ones who are going to negotiate the best possible terms on that property for you. They're going to drive you around. They're putting in all the legwork. They deserve anything that they can get paid to sell the property because they're going to work to find that right property for you. Anyone can list a property. I can list my own property online. It's the buyer's agent job to find you that property and get you the best possible terms for that property. So I highly recommend, once you've done everything else I said, you get pre-approved, get linked up with a reputable buyer's agent to help you find that right property. And now that you have a better understanding of what goes into being a home buyer, I hope you have more confidence in becoming one. If you have any questions about your specific scenario, please leave a comment below. I reply to 100% of the comments left on my videos, and make sure to subscribe if you'd like to continue educating yourself on all things mortgage and real estate related.